oil prices ease off. And here's our India Energy Week energy segment. Oil prices paused their rally on Tuesday but remain near 4-month highs, with the markets now focused on the impact of the latest US sanctions on Russian oil exports to India and China. Brent crude was down almost 50 cents to about $80.50 a barrel, or just above $80 on Tuesday evening, after having jumped 2% on Monday after the US Treasury Department imposed sanctions on two Russian oil producers as well as 183 vessels that transported oil as part of what they call the shadow fleet of tankers. So will the physical impact on oil supplies be as pronounced as feared? And what is the overall scenario building up to, particularly in the context of overall demand and supply trends as we advance into 2025? I reached out to Vandana, Singapore-based founder and CEO of Vanda Insights, and I began by asking her how she was seeing the bombshell announcement of the Biden administration to impose additional sanctions on Russian oil exports.
You're right. It was quite a bombshell. It has taken market participants by surprise. I would think it probably took the EU allies by surprise as well, because there was no response whatsoever to it, to the announcement from the EU all over the weekend. Of course, the UK joined the US as well in sanctioning a couple of the Russian producers. But market participants have certainly been caught unawares. It's become a big headache, especially for refiners in China and India. And as we know, and as you've been talking on your show through last year as well, pretty much 100% of Russian crude exports have been going to China and India. So Russia exports about 4.5 million barrels per day of crude, a little over 2 million barrels per day of refined products. Now, what the sanctions really stand out, the aspect that perhaps was the most surprising was how extensive they were. Aside from the fact that, coming from an administration that will be out the door in 10 days, and it really depends on Donald Trump and his administration, whether they scrap or they keep the sanctions or they use them as leverage. But aside from that, the wide-ranging nature is a first in terms of all the sanctions we've seen implemented since 2022. So this time they are covering the entire supply chain, from a couple of Russian producers. Of course, they are the smaller producers compared to Rosneft, but nonetheless, they, together, Gazprom Neft and Surgutneftgaz pump about 1 million barrels per day. So that's substantial. The sanctions cover a range of shipping companies, ship owners, operators, about 183 vessels, most of them oil tankers that the US says were used in transactions that busted the $60 barrel price cap. The sanctions cover two major Russian maritime insurance providers. They cover a whole scores of middlemen, trading companies that are instrumental in conveying Russian crude and refined products to the markets. So it's quite wide-ranging. Some of the implementation measures were not clear for several hours or a few days after they were announced, which has caused quite a bit of confusion and chaos amongst refiners in China and India.
Right. So you said 100% of Russian exports go to China and India. For India, it's about more than 30% of its imports. So what happens now? So will Russia be forced to export at lower rates, including that $60 price, which in a way could be beneficial then for India for sure, and maybe China as well?
That is the hope of the US administration, because let's face it, that's the sort of interim aim. Of course, the final aim is to get Putin to withdraw from Ukraine, but that's the interim aim. And that is the hope. Most likely it will, because as it gets harder for Russia to ship its crude to the destination markets, the freight rates go up. And when freight rates go up, it is a buyer's market, right? China and India, the buyers are going to say, it's become too expensive for us. So in return, then, Russia has to reduce the FOB price of crude. So that is the idea. I think refiners will be looking for that. But as I said, it's not as simple as that. It is going to cause a lot of other headaches. It already has started causing a lot of concern and consternation amongst refiners because, are the banks going to take the risk? Because as I mentioned earlier, so many sanctioned entities are involved. Even if the buyers can guarantee that the crude they bought was sold below the price cap, there's a whole lot of other sanctioned entities along the way that could cause problems.
Right. So if one were to now look at this in the context of how demand and supply is shaping up in 2025, at least the early part of 2025. What are the trends that you're seeing?
Quite interesting, Govind, that the way the year has started off, it's been absolute contrast to what was the overwhelming consensus view pretty much through the fourth quarter of last year. And mind you, that view hasn't changed. So when a lot of analysts said, and ourselves included, that we expect prices in general in 2025 to be softer, Brent average, we have forecasted around somewhere in the range of $70 to $75 instead of $79 average of last year. That big picture has not changed. That stems from concerns that there's going to be a global economic slowdown. And mind you, those concerns have actually intensified in recent weeks. We've seen a lot of risk aversion in the stock markets. Crude has been insulated from that partly earlier because of the colder than normal temperatures in the Northern Hemisphere, and then after that because of the sanctions. But that is still our view for 2025, that we're probably going to see a sort of balanced to slightly oversupplied market, which means lower prices on average than what we saw in 24.
Is there any shifts that you're seeing in the energy mix as such into 25? Any secular shifts, any long-term changes?
So on the whole, sort of narrative or theme or ethos seems to be and this is not recent, but sort of continuing over the past couple of years, that let us be careful in how we transition. This transition itself has to be sustainable. I think in some ways this is going to be amplified with the Trump and the Republican agenda coming center stage in Washington, D.C. We already saw the last few weeks, more major Wall Street banks have left the net zero alliance. This idea, which is now, I think, gaining ground even faster, that, of course, we need to transition away, we need to decarbonize, but we need to do it carefully. I think on that, probably I will, however, point out that with regard to China, it is a slightly different kettle of fish. There, the country is increasing the penetration of EVs at a far faster pace than any other country in the world. It's also replacing diesel use in trucks and buses with LNG. So in China, probably we are seeing that happen quite fast. In South Asia, Southeast Asia, we're also seeing governments give a lot more emphasis to biofuels. So all of these and renewables. So I think all of these will continue to happen. But at the same time, what I would say is a very welcome sign that governments, policymakers, and now financiers of the energy industry and energy industry players themselves are becoming much more cognitive that we need to be very, very careful how quickly we transition and the mode of transition away from fossil fuels.
Right, Vandana, that's a good note to end on. Thank you so much for joining me.
Thank you for having me.